Welcome to the deep dive. Today we're getting into the weeds with Computer Age Management Services Limited, CAMS.
Yeah, a really key player in the background of India's financial services.
Exactly. We'll be unpacking their latest results, Q4, and the full financial year, FY25.
And we're working directly off the official stuff here, the earnings call transcript and their presentation from May 6, 2025.
Our mission, as always, is to pull out the most important bits, those nuggets of insight from these dense documents.
Right, to help you really get what's going on with CAMS beyond just the headline numbers.
So let's jump right in. How did the full year FY25 look overall? Sounds like they had a pretty strong run despite some market chop.
Absolutely. Pretty strong is a good way to put it. For the full year, their total revenue was up a handsome 25%.
Okay, 25%.
And what's quite interesting is that both the main mutual fund, the MF revenue, and the non-MF side grew at almost exactly that same rate, around 25% each.
Huh. That's quite symmetrical. Shows the other businesses are really contributing now.
Definitely. It means that diversification strategy is, making a real impact on the top line.
So that non-MF part, how big is it now?
For the full year, it accounted for 13% of the total revenue.
Okay. And profitability, how did that shape up?
Also strong. Absolute EBITDA, its earnings before interest, taxes, depreciation, and amortization grew by almost 30%, 29.7% to be exact.
Wow.
And their EBITDA margin for the whole year landed at a handsome 46%. They pointed out it's been hovering in those mid-40s for about 6 quarters now.
That kind of consistency at 46% margin is pretty impressive. What about the bottom line, Pat?
Profit after tax, Pat, that also grew nicely, up 33% absolute growth for the year.
Okay.
And the PT margin came in just shy of 32%.
You mentioned market challenges earlier. What were they actually up against in FY25?
Yeah, the management specifically called out that this growth happened even with sustained pressure on market indices, especially from September through to March.
Right, that period was tough.
And they also saw some moderation in new demand and broking accounts opening up, and even a bit of a slowdown in SIP inflows in the latter part of the year.
So achieving that 25% top-line growth against that backdrop, yeah, that makes the performance stand out more.
Exactly. Context is key there.
Okay, let's zoom in on the most recent quarter then, Q4 FY25. How did things look just for those 3 months?
So for Q4 specifically, revenue landed around the INR 355 to 360 crore mark.
Which was actually down from Q3.
It was, yeah. Q3 was higher, around INR 370 crores. But compared to Q4 last year, it was still up. Year-on-year growth was just under 15% for the MF business and about 15.8% for non-MF.
Okay, so year-on-year growth is still solid, but that quarter-on-quarter dip, what drove that roughly INR 14 crore drop from Q3?
They broke it down pretty clearly on the call. Only about INR 3 to 4 crore of that drop was, operational stuff.
Okay.
The rest, the bigger chunk representing about a 2% to 3% dip, was directly because of a price adjustment they'd actually flagged on the previous earnings call.
Ah, right, that repricing.
Yeah.
So that hit the Q4 numbers directly. And the non-MF share in Q4, did that keep climbing?
It did, yeah. It inched up to 13.7% for the quarter.
Okay.
And the goal they mentioned is to keep a, quote, perceptible differential in growth rates. They're projecting another 20-25% growth for non-MF again in FY26. That's central to their diversification story.
And profitability in Q4, especially with that sequential revenue dip, how did margins hold?
Well, absolute EBITDA still grew about 12% year-on-year in Q4.
Right.
But the really telling thing was, despite revenue falling from Q3, they delivered an EBITDA margin of 44.9%. It's really close to 45%.
Wow.
They presented that as a, quote, testament to the resilience of the entire model, because their core costs apparently stayed static even though AUM didn't grow quarter on quarter.
That is resilient, holding near 45% when the main driver flatlines.
Exactly. And PAT, the net profit, grew about 10% year-on-year, with the Q4 PAT margin at 31%.
Okay, that resilience is a key point.
Yeah.
Let's pivot back to the core business mutual funds. What were the main highlights there from FY25?
Right, the core MF engine. Market share by assets stayed strong, around 68%. And they're servicing a big chunk of the industry, 26 out of the 51 active AMCs.
Mm-hmm.
Their overall AUM grew 24% year-on-year, which basically just mirrored the industry's growth.
Okay.
Equity assets were particularly strong, growing about 29%, and actually crossed the INR 25 lakh crore mark.
Big number.
Yeah. Shows investors kept faith despite market swings. Equity net inflows. Well, they were almost flat year-on-year in Q4 itself. But for the full year, FY25, equity net inflows were up a massive 86% compared to FY24.
That full year inflow number is huge. And SAPs, Still the main driver for retail.
Definitely looks like it. The S&P momentum was, well, strong. They highlighted that S&Ps actually brought in more money collectively in Q4 than in Q3.
Interesting. So resilient there too.
Yeah, and the number of live SAP accounts grew about 18% to around 5.7 crores. Plus, gross new SAP registrations for the full year jumped significantly, up 51%.
Wow.
And they also crossed the 4 crore mark for unique investors, growing 26%, which was actually faster than the overall market's investor growth of 22%.
So solid growth in all the key MF metrics. Now, you mentioned something earlier about their pipeline for adding new AMCs. That sounded quite significant.
Yes, this was quite a notable point. In Q4 alone, they took 2 new AMCs live, Angel One and Unify.
Okay.
That brought their total to 21 live AMCs. But the key thing management stressed was, for the last 9 years, they haven't onboarded more than 1 new AMC in a single year. So getting 2 live in just 1 quarter is a real step up.
2 in 1 quarter after years of 1.
Yeah.
Yeah, that's an acceleration. And there are more coming.
That's the plan. They expect 5 more to go live within the next 6 months.
5 more in half a year. Who did they mention?
Let's see. The names were Geo BlackRock, Pantamath, Choice, Taurus Oro, and CBank. Plus, they hinted at 1 more unnamed one.
Wow.
They clearly see this as the big positive, investing in the platform's future and setting up for more scale later on.
That pipeline is definitely something to watch. Okay, let's shift to the other side, the non-mutual fund businesses. This is their big diversification play. What's the overarching goal there?
The main message is that building this portfolio shows, as they put it, the faith of the marketplace in CAMS beyond just MF. And the goal is to keep delivering that high double-digit growth, targeting 24% to 25% growth again for non-MF in FY26.
And the profitability of these newer businesses, are they pulling their weight yet?
Well, the combined EBITDA margin for all non-MF segments is currently between 10% and 15%.
Okay, so lower than the core business for now.
Right. But the expectation, the target, is to get that combined non-MF margin up to 20% next year. They acknowledge it's a niche.
Okay.
We've got profitable bits like KRA services and payments. And then the growth areas like account aggregator, CRA, the insurance repository, Think Analytics, those are still, turning the corner profitability-wise.
Got it. Let's maybe drill down into a few of those. CamsPay, the payments arm, had some pretty eye-popping growth.
Phenomenal, yeah. CamsPay revenue grew 85% year-on-year in Q4.
85%.
Huge number. And they're really pushing to diversify its use cases. It's not just MF anymore. They're moving into education, collecting fees for universities, colleges, hospitals, and insurance. Signed up 5 new insurance clients recently.
And they mentioned LIC of India for payments too, didn't they?
They did. They signed LIC up for account authentication services back in March, April 24. That's starting to scale now.
Authentication, not premium collection.
Not yet. They were clear on that. But the goal is for it to become a, quote, large-ish account. Although they did temper expectations slightly for FY26 growth contribution from this specific LIC deal, probably less than 10-15% of CamsPay's growth next year.
Okay. Any new products or innovations in payments?
Yeah, a couple of interesting ones. They launched something called Bima as BA.
Bima as BA, like for IPOs.
Exactly the same concept, but for insurance premiums. You block the funds. It helps address that regulatory concern about delays in premium refunds if the policy isn't issued. It seems like it. Also, UPI AutoPay looks promising. Transactions grew almost 25% just quarter on quarter. And they've built out their own payment gateway product and are actually getting revenue from that now, too.
So building out the whole stack.
Pretty much.
Yeah.
And looking ahead, they expect a big shift in CamsPay's revenue mix for FY26. They're aiming for 60% of its revenue to come from non-MF sources and only 40% from MF-related SIPs.
Wow, 60-40 non-MFMF within payments itself. That really shows the diversification drive. What about the alternatives business, AIF, WealthServe?
They called Q4 a very strong quarter there. Landed 56 new mandates just in Q4.
56.
Yeah. And for the full year, across alternatives and WealthServe, they won over 200 new mandates.
200.
They used words like astounding numbers, indicating significant solid market leadership. They reckon they hold about 50% share of the outsourced market, even with more competition popping up. They're also apparently the biggest player in Gift City, over 30 clients there, and have strong digital onboarding, over 200 installations. Revenue grew about 17% year on year in this segment. They did note it's more of a fixed price kind of market, so the basis point yield isn't like AUM-linked fees. And management made a point about focusing on a pristine portfolio, not just chasing client numbers with low-value deals.
Makes sense. How about CamsRep, the insurance repository? Any movement there?
Yeah, some positive updates.
Yeah.
Market share has improved, now over 40%. It was more like 37, 38% before.
Good progress.
And the big news, LIC of India signed up for repository services too.
LIC again. They're signing up everywhere.
Seems like it. Integration is happening now, but they said real policy flow from LIC will likely start from July, initially just for digital issuance,
Okay.
the potential impact. They estimate LIC could add 15, 20 lakh policies this year, on top of the 40, 50 lakh base growth they already expect. They even suggested that if LIC puts its full weight behind it, it could double the market's pace of policy dematerialization in maybe 3-4 quarters.
That would be huge for the repository business.
Absolutely. Total e-policies on their platform have crossed 1 crore now, around 1.1 crore, and pricing seems stable. Contracts are long-term. They also mentioned integrating with Bima Central for electronic services, reminders, payments, claims, where the yields are apparently better.
One clarification, though, did LIC sign exclusively with CAMS?
No, good point. They mentioned LIC signed with CAMS Rep first, but the plan is for LIC to sign up with all 4 depositories eventually.
Got it. Okay, next up. CAMS-KRA, the KYC agency. How did that business do?
Well, Q4 was a tough quarter for KRA, directly because of that slowdown in new folio, demat, and broking accounts we talked about.
Right, the market effect again.
But despite Q4, the business showed resilience over the full year. FY25 revenue for KRA was still up over 30% year on year.
Okay, that's decent resilience.
And they're diversifying here too, adding 3 big brokerages, top 10 names they said to process payloads for. Revenue is split roughly 65-70% from MF onboarding and 30-35% from the demat broking side.
And that broking side is a bigger market.
Yeah, they highlighted that. It's about 3 times the size of MF in terms of new accounts opened each year, so potentially a bigger pool to fish in. They also mentioned some innovations like 10-minute KYC, their Nexus dashboard, and even WhatsApp KYC.
Keeping things modern.
Trying to. They're still the second largest KRA, market share around 20%, holding over 1.9 crore PANs.
Any other ventures quickly? Fintuple,
Yeah.
360.
Briefly, Fintuple is their entry into NPS, the pension system. They won their first deal to build a back-office platform for a pension fund's coin-of-presence business.
Interesting.
And Think360, the AI data science arm, launched a personal finance management product. They're doing a big implementation for a major financial app. Plus, they've launched AI products and co-developed an AI surveillance tool with a regulator. So definitely pushing into fintech adjacencies.
Okay, quite a bit happening on the non-MF side. Let's circle back to the financials and outlook, especially those investor concerns. Yield compression was a big topic, right?
Definitely the elephant in the room on the call. So the average AUM fee rate, the basis points they earn on assets, came in at about 2.24 BPs for Q4 FY25.
And that was down from Q3 because of that repricing.
Exactly. That was a 4% sequential drop just from the AUM fee component, reflecting that price adjustment taking effect.
And how does that repricing impact spread out over time? Is it all done now?
Not quite yet. Management explained it's staggered. About half the impact hit the Q4 numbers. The other half will phase in over the next 1 or 2 quarters based on the contract terms.
Okay.
So for the full year FY25, the average BPs was about 2.33. That was already a 6-7% drop compared to FY24.
Right.
And looking ahead to this year, FY26, they expect another drop of roughly 7-8% compared to the FY25 average, maybe closer to 7%. The exit yield, Q4 FY26, is projected to be about 4% lower than Q4 FY25's level, so around 2.15 BPs versus the 2.24 we just saw.
That's a noticeable ongoing compression. What was the reasoning given for this, and are more surprises like this likely?
Ram Churan from CAMS explained it wasn't a delay, just how the contract worked. He framed the repricing itself as seeking parity in a non-parity-led world.
Meaning?
Basically arguing that as services become more digital and standardized, the justification for wildly different prices between similar-sized clients shrinks. They don't see this specific issue recurring after this plays out.
And no other big contracts coming up for renegotiation soon.
They gave assurances on that. No major new contract talks or expected yield drops in FY26. The big ones, including the one causing this adjustment, are done. Smaller ones always come up, but nothing on this scale. The idea is, after this, prices for similar AMCs should be much closer, reducing future shocks.
Okay, that context helps understand the yield picture. Now, what about bringing all those new AMCs online? Does that hurt margins initially?
They think the impact will be too small to create a drag on FY26 margins.
Really? Even with 5 coming?
Yeah. Apparently, the cost to get them ready tech, people are largely already in the base costs, since that work starts maybe 6 months ahead. They see the new AMCs as a definite long-term positive for scale and revenue,
Right.
outweighing any small initial cost pressure.
Makes sense. What's the overall cost outlook for FY26 then?
Overall, they expect costs to rise by less than 10%.
Less than 10%. That sounds quite controlled.
It does. Employee costs, they expect stability or maybe even a slight decrease as a percentage of revenue.
Hmm.
Q1 will see the usual appraisal impact, which might dip the margins slightly for that quarter, maybe to 42.5, 43%.
Right.
They did hire a lot last year, 750, 800 net additions, mainly for non-MF and new tech skills like cybersecurity, AI, which pushed up the average cost per employee.
Mm-hmm.
But for FY26, they expect headcount to be stable or even slightly down, thanks to automation and that re-architecture project of the core business. They said assuming employee costs around 33% of revenue is probably fair. And other expenses in Q4 had some one-offs, like expected credit loss provisions and legal fees for MF Central, not expected to repeat at that level.
So putting it all together, the rest of the price impact, cost control hopes, non-MF margin improving. What's the target EBITDA margin for FY26?
They're aiming for a 44% EBITDA margin for the full year.
Okay, so down from the 46% in FY25.
Correct. That factors in the yield compression, the target of 20% margin for non-MF, cost control. But it's also based on what they call moderate AUM growth. They're assuming maybe 11, 12% industry growth, not the 20% plus we've sometimes seen.
So if AUM growth surprises on the upside.
Then margins could potentially do a bit better than that 44% target.
Got it. What about investments, CapEx for FY26?
Total cash outflow planned is around INR 170 crores.
Okay. For what, mainly?
It's split roughly INR 100 crores for accelerating that big internal tech re-architecture project, and about INR 70 crores for regular IT stuff, servers, storage, and things mandated by SEBI, like building air gap centers.
And depreciation, will that jump with all this investment?
The Q4 FY25 depreciation run rate is probably a good guide for the near term. That reflects recent things like Oracle licenses, SharePlex, the air gap centers. The depreciation from the new re-architecture modules won't really kick in until those modules go live, likely towards the end of FY26.
Right, makes sense. They also gave a breakdown of the non-asset-based revenue within the main MF business, didn't they? That INR 200 crore chunk.
Yeah, Ramcharan broke that down roughly. About INR 71 crores from transactions, INR 34 crores from miscellaneous applications, INR 32 crores from the call center, INR 54 crores from OP&FO recoverables, and about INR 6.5 crores from NFO fees specifically.
Interesting mix.
Yeah, and they noted growth areas like the call center and applications, hinting maybe some value there isn't fully monetized yet.
How did their net sales market share look for FY25, capturing new money?
It was in the mid-60s to late 60s% range for the full year.
Down a bit from FY24.
Yeah, FY24 was higher, around 75%. They said it depends a lot on NFO activity in any given year.
Okay. And it was a question comparing switching costs to K-FinTech.
Right. Management's view is switching costs are very high because CAM is so deeply integrated into an AMC's operations liability, record keeping, everything.
Sticky business.
That's the argument. They pointed to public records showing, they say, 2 shifts from KFin to CAM in the last decade and none the other way, suggesting people should check specific names if they hear differently.
Okay, just a couple of quick clarifications that came up. Days in the quarter affecting revenue.
They confirmed revenue is based on average AUM for the month. So the exact number of days doesn't really change the monthly revenue.
Right. And that pricing for small SIPPs, Jan SIPP, Choti SP, is that just CAM?
No, they said it's an industry thing. RTAs, KRAs, depositories, payment firms, all providing some uniform differential pricing for these small SIPs. It was nudged by SEBI and AMFI to encourage scale.
Industry standard. Got it. And finally, employee count and KRA accounts again.
Employee count around 8,100, and KRA holds over 1.9 crore PANs.
Okay, great. I think that covers the key details from the call and presentation. Let's try and wrap up the core story here.
Yeah, I think the main takeaway is CAM showed real resilience in FY25. They managed good overall growth and kept core margins pretty stable, even with market headwinds.
And crucially, the diversification into non-MF is clearly happening and contributing.
Definitely. Looking ahead, it seems the big task is managing that core yield compression, squeezing out efficiencies through tech, like the re-architecture, while scaling up those newer non-MF businesses to get their margins higher.
Balancing act. Optimize the core, build the future.
Exactly. And that strong pipeline of new AMCs coming on board is a clear positive for future scale in the core business, which helps offset some margin pressure too.
So this brings us to our final thought for you, the listener, to mull over. We've heard about CAMs investing heavily in all these new platforms. Bima Central for insurance, their own payment gateway, the NPS backend, digital stuff like Bima SBA, 10-minute KYC.
Right. They're not just servicing existing markets anymore. They're actively building the underlying infrastructure, the digital plumbing that connects different parts of India's financial world, mutual funds, insurance, payments, pensions.
So the question is, what does their role become as these services get even more interconnected? Are they just a vendor?
Or are they evolving into something more central, a key enabler, maybe even the digital rails for how finance works in India in the future?
It's a fascinating angle on their strategic position, something to definitely think about. We hope this deep dive gave you the insights you need.